Welcome to the Real Property Show, where we talk about building, buying, and selling residential real estate. I'm Brian Freeman, and welcome to the show. Hey everybody, I hope you're doing really well. It's about 2 weeks before Christmas. I hope you have some time set aside for your family here coming up in the next couple weeks. I wanted to talk to you today about something that happens from time to time, and this just happened a couple weeks ago, so I wanted to share with you how we resolve an issue. And this is in regards to getting a construction loan and your appraisal actually comes in too low. And how do we actually deal with this, and what are some of the options? So, and I'm going to give you an example of what had just occurred. So the typical process for getting a construction loan is you're going to get your plans drawn, you're going to get your building agreement done, you're getting a specification package together and a cost breakdown, and that's what we would call the lender package. This lender package is then submitted to the lender, and then the lender hires an appraiser, a third-party appraiser, that then goes out and does an appraisal on the property. Now, the way that works is, but the appraiser is going to take a look at that lender package. They're going to look at that thing and go, this is the size of the home, it's on this size of a lot, it's in this location, and it has this level of finish. And then what they're going to do is they're going to find comparable properties that have sold, homes that are already been built that have sold, and see what they have sold for. Those are going to be the comparable properties, and they're going to come up with a value based on, after construction, what this home would be worth, and that's going to come back with their appraisal. So that's the typical process the appraiser goes through with us submitting to the lender. The lender actually hires the appraiser, and then the appraiser does what we just talked about. So once that's done, the value comes back to us. So typically with a construction loan, what happens is you are going to be working with a loan to value ratio as the borrower. So the lender looks at you, they look at your debt to income ratio based on what the total loan amount is, and see if you can cover this with your income. A lot of time they'll go anywhere. It could be a 30% debt to income ratio, it can go all the way up to 50% debt to income ratio, depending on the lender. They have different underwriting guidelines as far as how they determine what's the max that you can go. So you get that information by submitting their financials to them, and you find out how large a loan you can qualify for. So the other thing they'll look at is the loan to value ratio. So they're looking at the property. So they look at what's the value of the property, which is established by the appraiser. And then they say, well, if we're going to do an 80% loan to value, then they'll lend up to 80% of the value of the property. So meaning you have to have 20% equity, a 20% equity position in the property, or 20% down payment. If it's a say they want a 75% loan to value, you'd have to have, they'd lend 75% of the value, you have 25% equity position or 25% down payment in the property. Now, how do you get that down payment, or how do you get the equity position? Can happen a couple different ways. So this particular client owned the property. So the property has a value by itself without a house on it. It's worth so much money. They also, and they own, this particular client owns this property free and clear, no money owed on it. There's no land loan or anything on there. So the equity in the property is 100% in the land currently. So the other way to get a down payment is to actually take the money out of the bank and put that into the deal. So this particular deal, here's what happened. So the value, the build cost on this thing, there's quite a bit of site costs on this project because of the requirements that are on this particular property. And I think the build costs are right around $800,000. So about $800,000. The appraisal came in at $875,000. So you have the cost. So remember, they own the land. So at that point, they're looking at they have $75,000 right there that they have in equity in the property once the property was built. Okay, but the lender wants them to have a 20% equity position or 20% down payment in this property, so they'll lend up to 80% of the loan to value of the loan, or the value of the property. So what happens is they're now short about $100,000. So this particular value came in at about $875,000. So if you take $875,000, multiply that by 20%, that's $700,000. So, and the cost to build this project is about $800,000. So the difference in this is we have to get from 800 down to 700. So the customer that we're building for has to come up with another $100,000. Okay, so where do we get the 100 grand? So the solution to this problem, and this is one that you can that works, and the banks will allow you to do this. This particular customer owns their home, and they have a significant equity or significant equity in this property in their existing home that they live in right now. So what the lender is allowing them to do is they're allowing them to get a home equity line of credit on their existing home that will then allow them to use that as the down payment, the additional $100,000 for this project. Now, the one trick to that is you have to have a high enough income so your debt to income ratio is going to still be okay. Because if you're right up against the edge of your debt to income ratio, say the lender allowed 45% debt to income ratio, and you're at like 44, and then you pull a $100,000 equity line out on your primary residence, they are going to count. What they do is they look at that and they go, well, if this person the borrower drew out all the $100,000, what is that payment? Interest only payment, or if it's principal and interest, whatever the terms are in that loan, they're going to look at the maximum payment that is possible on the terms of that loan, and then they're going to count that against. That's your debt service, so that'll increase your debt to income ratio. So you got to make sure that your income's high enough so that debt to income ratio doesn't exceed the underwriting guidelines for the construction loan that you're getting ready to get. Okay, so then what happens is once the debt to income ratio has been verified by getting a HELOC that it's okay, then the lender's going to take that $100,000 and you're going to need to actually pull that money out of the home equity line of credit and put that money down prior to the closing of the construction loan. And then the lender uses that money to help disperse the funds for the construction loan and to complete that project. So that's one way to get around if you have a low appraisal. So there's other ways to do it, but that is one that works really well. It works good on a primary residence. Those HELOCs are easiest to get on a primary residence. You can get them on investment properties, but the loan to values are a lot lower, so you're not able to pull as much money on those other investment properties. And there's few banks that do that. There's your credit unions, what I'm trying to say, are the ones that will a lot of times touch that because they're using different funds that they get from different investors. So, all right, so I hope that helps you. If you'd like more information on how to build a home, buying land, or anything else that we can help you with, visit our website at tfgonline.com. Go to our resources page. We have a ton of information there. It's also an FAQ page that has a lot of information that you get from us. So, all right, thank you so much for your time, and have a great rest of your day.